Welcome to the AUA Leadership and Business Podcast, where urologic professionals experience the practical application of business acumen essential to successfully navigating today's rapidly changing business environment. Thank you for joining us, and we hope you enjoy this episode.
All right, welcome to the AUA Leadership and Business Podcast, where urologic professionals experience the practical application of business acumen essential to successfully navigating today's rapidly changing business environment. I'm John Lacy, and joining me today to discuss saving and spending habits that include helpful investing principles are Sammy Elsamra and Tadros. This is the first of 3 episodes in this podcast series that focus on personal finance. Subsequent topics will include investing as well as insurance. So we encourage you to check out these episodes as well. I wanted to start off by just kind of introducing ourselves and talking about how we each got, interested in personal finance to begin with. So, Sammy, can you get us kicked off?
Sure. Yeah. Thank you very much for having me. It's really a pleasure. This is a topic that's near and dear to my heart. So I'm really excited to talk about this. My name is Sammy Elsamra. I'm associate professor of urology here at Rutgers Robert Wood Johnson Medical School. My practice is focused on robotic urologic oncology and reconstruction. And I did my residency at Brown University and my fellowship at LIJ. I joined the practice here back in 2014. And I think, just like most folks here, I think, I went into college and medical school and residency with very poor personal finance literacy. And we borrowed a lot of money to go through school. And then in residency, I kind of did that. I think things were a little bit different back in my day, unlike now, but I deferred a lot and didn't pay off any of the loans. And I think the environment's a little bit different now, but I probably aggregated a good $160,000, $170,000 in debt by the time I came out of all my education and after deferring. So, I was a newly minted urologist in an academic practice, and I saw that I got some of these loans in front of me, and I thought, oh, it's no big deal. I'll just pay it off little by little, and I realized that the payoff was pretty significant amount of money out of my monthly paycheck or a biweekly paycheck, and it was going to take a long time. And I think what really woke me up was, I got a lot of conflicting advice. I had a lot of friends who were in medical school who said, just defer. It's low interest loans. You can take forever to pay it off. And I think I hit a point where, I really just felt uncomfortable holding on to this amount of debt. And so I started reading, and I think a lot of my knowledge comes from the White Coat Investor. I learned a lot from reading that guy's books. He has 2 or 3 books out that I read, and then listening to his podcast. And it's really opened up my eyes to personal finance. Just a quick anecdote, and I'm sorry this has been a long-winded intro, so I apologize. But I'm the child of immigrant parents, and my upbringing was pretty modest. We were rich in a lot of things, but not so much money. And so I saw that lifestyle and how my father was very very thrifty, and he really was like very conscientious about where all his spending went. And we didn't have the biggest house or the fanciest cars, but we didn't want for anything. But again, we just didn't have that. And then I married a physician. My wife is a physician. Her parents are both physicians. They were very well to do. But as I saw both of them age, I noticed the difference between being rich and looking rich. And I think you could be one or the other. You can't, it's very, very rare for you to be both. And, I think my father, a lot of credit goes to him, and I see it more and more as I get older and older. Uh, he has really just focused on saving and investing, and he's built some real estate investments and stuff, and these investments are really coming into play now and helping him out at a time when his work revenue, his small business is declining, and he's looking towards retirement. Contrast that to my in-laws, where they were physicians, and God bless them, they had a lot of fancy, pretty things, but as they come towards retirement, I don't think they're as prepared, and that's caused a lot of difficult decisions that need to be made and a lot of angst. So that's really the impetus for my interest in personal finance. I mean, I see two examples right in front of me in my parents and in my in-laws with how to behave regarding your personal finances.
Awesome. Thanks so much. As I look at what piqued my interest, I have a very similar story to Dr. Elsamra. I also somewhat of a modest upbringing, and no real formal training in personal finance from my parents or other teachers along the way. I was 2 years into training. I was studying for oral boards, and I just honestly wanted to listen to a podcast about something other than testicular cancer or metastatic prostate cancer. And so I got on the White Coat Investor podcast as well. And it was really eye-opening, but I've used that in the subsequent 5 or 6 years to learn a lot about personal finance. It's given me a lot of just ease a lot of anxiety about pressures to produce in certain financial ways. It's given me more control over my current and future lifestyle and hopefully management over my time in the future. I think that certainly with our upbringings, that's going to play a big role in how we think about money. And we'll get to that later in the podcast. But Dr. Tadros, what kind of got you interested, and tell us a little bit about yourself as well.
Yeah. So I'm Nick Tadros. I'm assistant professor at Southern Illinois University. And I've been there for my entire career in academics. I did my residency at OHSU in Portland, Oregon, and my fellowship in men's health and male infertility at Cleveland Clinic. So that's kind of where I am. And my interest in personal finance is actually very similar to Sammy's, including the kind of the same parents' experience. So my dad also is an immigrant, relatively uneducated, came to the States, kind of lived the American dream, actually made quite a bit of money with his small business. And then in 2008, with sort of the crash of 2008, essentially lost everything. And I was an intern at the time. And so I watched my parents go through losing essentially everything they owned. They used what retirement they did have, retirement money, to put it into the business to try to keep it afloat because that was their only source of income, and essentially lost everything. And I think part of it was just obviously the kind of the financial crisis. Part of it was also, I think, quite frankly, their poor planning. My dad was a very hard worker, worked very hard for his money, and was also very generous with his money in terms of giving to charities and to people in need, which was great to see, but he never really had a plan for himself or his family. And that all kind of came to a big, unfortunate crash in 2008. So I saw that, saw my parents go through that. They had to file for bankruptcy. They went from living in a beautiful home and nice cars and to essentially nothing. And that kind of was my first step into really, it terrified me, quite frankly, that I did not want to be like that. I didn't want to have to go through that and see my family go through that, see my kids watch me go through that sort of thing. So that was the first step to me, sort of really thinking about wanting to be more interested in personal finance and my own sort of future financial well-being. And then I went through training, as most of you know, as you're going through training, there's not a lot of ability to sort of save and invest, but I did what I could. And then near the end of my residency, just like Sammy and John, I got a copy of the White Coat Investor. I still have my original copy that has all these notes in it, where I circled things like, said, this is life changing. Oh my gosh, I want to be like this, when I grow up, that sort of stuff. It was a pretty seminal event in terms of my personal finance education. And then that set me on the path that I am now, where I try to give personal finance talks to my residents. We talk on a regular basis. I buy them finance books. I actually ended up getting my MBA a couple of years ago, also just sort of because of my interest in personal finance and finance in general. And that's sort of what kind of got me on this pathway. So not unlike Sammy and John.
Well, awesome. We're finding more similarities and differences so far. So, yeah, and again, I'm John Lacy. I did my residency training at the University of Kentucky. I did a fellowship in male reconstruction and prosthetics at Cleveland Clinic, and I'm now down at the University of Tennessee in Knoxville, where I'm the program director, which is a lot of fun. And I also, as Nick was saying, try to share what I can from the knowledge I've accumulated, but also the experiences that I'm going through, as I'm less than 10 years out from training, and that's been pretty well received by the residents. So we each had obviously very formative experiences, growing up from our parents and things that happened to them. How would y'all say that this has affected the way you look at different aspects of personal finance? I think two things that often come up in these forums are the idea of investing versus paying off debt. A big example of that obviously is student loans, and budgeting. So Sammy, how have your personal experiences affected your outlook on those two things?
Yeah, I think there is this concept of arbitrage, where you look at what the market's doing, what the market return is going to be, and I think we had a really nice long run where you could expect 7-8% returns on your stocks. I think those days are now gone. I don't think that return is there anymore. During that same period, interest rates were really low. So if you had student loans sitting at 2% or 1% or 3%, it probably made sense to put your money more in investments and kind of come out ahead, as opposed to losing 2%, you're gaining 7%. But I think that's probably changed. I personally, there was just something in me that I couldn't hold on to these loans at some point anymore. I just felt like it was a monkey on my back, and I felt that it was a priority to get rid of them. And I think the benefit of paying off loans aggressively is that I'm sure it's a dopamine kick or something, that when you finish paying off those loans, one, you feel on top of the world, but two, I think that act of saving up and paying all that money to pay off loans really sets you up. And now you're like, well, I was used to making this huge payment to overpay my loans, every month or every few months, I would put in this extra amount of money. And if you've built that into your behavior, I think it's just a natural progression to take that behavior now and do that into your savings. So like the same thing that you did with your student loans is the same thing you do with your mortgage, is the same thing you do with other investments. And I think that's really how you grow. I don't know if that's what you were looking for, John.
Yeah, absolutely. Yeah. And I would say the same thing. I mean, you mentioned in your first in your kind of intro that you had many people telling you to defer loans, and I had the same thing. Why would you pay down that low interest loan? But the problem is, I know for me personally, I was debt averse. Again, a lot of it probably due to my upbringing. We didn't carry a lot of debt, and I've always been kind of terrified of credit cards or any sort of large amount of debt. So I loved the idea of paying down loans, and since I did pay them off, and that was dopamine kick is a good way to put it. That I still remember that day very vividly. It was huge to pay that off, But to your point, those habits of paying large chunks whenever you got a bonus or with every paycheck developed habits over those first like 3 to 5 years outside of training, and now those dollars had a home. And so then instead of just paying the loans, then I've used those dollars for other investments. So for me, that was great. Again, there are other people you can make a mathematical case for investing versus debt. But I know for me personally, I wouldn't invest every single dollar in that spreadsheet into some sort of reasonable investment. I think I'd spend it more on lifestyle creep. What about you, Nick?
Yeah, no, I agree with you guys, and I think, and you guys have both said this. I think the important thing is developing those habits of contributing to your wealth early on. So to your net wealth, improving your financial bottom line early, and whether that's paying student loans or investing. I think as long as you're doing one and doing it, putting quite a bit of money into those, I think you probably can't go wrong. Obviously, like Sammy said, mathematically, you can always look at the math, and oftentimes it's, as of, up to a few months ago, it was more reasonable to be putting your money into investments and not paying the student loans off. The bulk of my student loans were at less than 1% for several years. So it didn't make a lot of sense to take my free money and put it in that as opposed to investments. Now, obviously, things are a little bit different. Interest rates are much higher. Return on investments is much lower depending on what you invest in. And so, mathematically, maybe it makes more sense to pay off the debt. But I think regardless, I think it's important, and I try to do this, and this is what I tell my residents, is to develop those habits early on, right out of residency, so that you're taking a large amount of your money and putting it into essentially wealth building. I know, as Jim Dolly, the white coat investor, always says, when you come out of residency, the vast majority of us are poorer than even the poorest person that we see on the street. Even the homeless person or the person in Africa who has trouble finding food doesn't have a negative net worth. And we have coming out usually have substantial negative net worths. And so I think it's important that young physicians or older physicians recognize that and essentially have a plan to reverse that as quickly as possible. And again, I think putting a lot of money towards wealth building in terms of either paying down your student loans and or investing, especially early on in your career, really tough.
But it's tough, right? Because there's this concept of the arrival fallacy, right? For all those years of training for urology, 4 years of medical school, maybe some research, 5 or 6 years of residency, perhaps more research fellowship for all three of us. You got this date at the end of that timeline that you've been looking forward to for a long time, and you do see a substantial increase in your paycheck, but then you also it can really fly out of the account really quickly, especially again if you get out. Whoa, I need to buy a house. I need a nicer. I need a doctor car. I need a doctor house. I need to live in this school district and this neighborhood and all that stuff. It's amazing how fast that money can go, and especially if you're not watching it. If you're just looking from month to month, you can afford most things, but you can't afford everything. And when you look at how that plays out from a compound interest standpoint over the course of your career, it can be devastating.
Yeah, John, that concept of when you finally come out of training and you've got your first job, that moment you want to just break free. I think that's a critical moment right there, and I think hopefully for all the residents listening, and hopefully it's not too late for some of the young urologists listening. You got to live below your means, not at your means. You got to live below your means. You need to set some priorities. I think and I think a lot of the folks who are in the personal financial wellness space talk about having an emergency fund of 6 months. Like if like you find your job is miserable and you cannot continue and you need to stop, right? If you have 6 months of an emergency fund, then you could afford to stop. You could leave your job, and you could do something else, locums or whatever. You can figure it out. But if you are living at your means, then I think you're going to be a slave to the system. And to quote another quote that I've heard, in a lot of these podcasts is like, every dollar you spend, right, is either part of like your history or your future, so like, if you bought something on credit, or if you bought something and it's layaway, you're marking those dollars in the future for that thing that you bought. Whereas if you're gonna, save up money and buy something in the future, I think that's a behavioral, concept that's really important for saving up for the future. I think that's a much more financially sound model. So really trying to be debt averse and kind of earmarking your budget appropriately, I think that's a critical concept.
That's a good segue. So, what do you guys do for budget? Do you track everything in YNAB or Mint or Personal Capital, or do you prefer like I've gone more towards a reverse budgeting type thing since paying off most of the debt. What do you guys do in that arena?
Yeah, so I do the same thing. I do like the reverse budget or the pay yourself first budget. It's the same thing. And for those of you who don't know, that's essentially where you first, the first thing that hopefully automatically comes out of your paycheck, or if not, you pay it yourself very quickly, is you put your money first to yourself, which means paying down your student loans, investing, all that sort of stuff. And then whatever money you have left, that's what goes to your mortgage, goes to your, your car you want, that country club membership, whatever it may be that is your heart's desire. But I think it's really important to get into those habits, just like Sammy and John said, of paying yourself first and putting that money aside for your future before you start spending all the extra money. In terms of how I do it, I actually do everything you just said, John. So I spend my money in sort of a reverse budget way, but I do track all of it. So I use Mint, which is an online app and website to track my cash flow and my spending. It works really well. And then I use Personal Capital, which is another app, to essentially track my investments a little closer. So while I do sort of keep track of essentially all the dollars that I spend, I keep track of it more for, I guess, my own neurosis than anything else. But I don't really use that as a way to budget my money. Like, I'm going to spend $300 this month on clothing, $500 on restaurants. I just sort of keep track of it just to know. And an added bonus of that, at least for me, I do all my own taxes, so I don't use a CPA. And it's really nice at the end of the year to be able to essentially have all that already tracked, so I know exactly how much I spent at work, how much I spent on things for work, on gas, all that sort of stuff that I can use for my taxes. So
I talk about reverse budgeting now, but I think it is essential when you first get out, or when you kind of stabilize, because there are obviously expenses with moving and getting set up in a new place and everything. But I think you have to know where the money is going. Just knowing where the money is going is a big part of it. And then it's kind of taboo, certainly in the personal finance forums and the financial independence, retire early or FIRE community. It's almost taboo to spend any sort of money. You can't buy a new car. You can't do this. You can't spend X amount on a house. But the whole point of being financially stable is to be able to do what you want with your money and your time, right? So I think that's a balance there. And if you have a plan for your money and you're intentional with your spending, then you can spend it on your money and your time how you want to, not how someone else tells you to. And I think that's a big concept for me.
And in some ways, I think it's freeing, actually budgeting and paying yourself first, because then it does allow you to spend your extra money how you want, even if it's on something that maybe someone else wouldn't want to spend money on. But you can do it, at least I think, in a way that you sleep so much better at night, because you paid yourself first. You took care of your insurance, your investing, your student loans, all that stuff first, and then the money you have left over, you can sort of spend it without having any regret. I think people who aren't tracking their budgeting and don't know where it's going, I know, at least personally, I would never sleep well thinking that, oh my gosh, the other shoe could drop at any moment, and I won't have the money to pay for that car or that house or that vacation or whatever. But when you do track it, and you do know that you sort of put the important stuff you've paid for first, then you can spend the rest of that money without regret.
Yeah, I think one important concept that, tacks on to this discussion of paying yourself first and reverse budgeting. For myself, I used to kind of maintain a budget, not a very strict one, but I used to maintain a budget before my student loans were paid off. After my student loans were paid off, and my income had increased a little bit, I felt that I could probably just do more of a reverse budget. But doing the reverse budget in an automatic fashion makes things a whole lot easier. So if you've automated your deposits into your retirement savings accounts, if you've automated your payments to mortgage companies and you do an extra payment, if you have an investment, an additional real estate investment, you've automated that payment. If you have even a bank account, some of these mortgages, you have to have a bank account affiliated with that mortgage, and just taking a cut out of your paycheck, it's the easiest thing. You just set it up, with your employer, and then you take a cut out of that paycheck. It doesn't even show up in your normal bank account, so that when you or your spouse or whoever looks at your bank account, it's not there. So it's not there. You can't spend it. It's great. It's in some other account doing real work for you, and you don't even feel it. And I think to add to that too, every time, because we come out and we think, oh, we're going to make X amount of dollars. And sometimes you think that's all I can make, but hopefully there is a progression, right? Your salary goes up as you get more experience, as you get more efficient, as you see more patients, as you do more complex things. And I think every time you get a salary increase, take a larger cut out of that paycheck and also put it to work automatically. It'll lessen the pain. You won't feel it as much.
I think, yeah, all that is great, and I totally agree with all that. I think that pretty much all these topics could be a podcast in and of themselves. So let's see. I'd like to move on a little bit to sort of general principles, right? So as we talk about how much you need to invest, how much you need to save, you need to sort of have a number. So that's where it does. I think most of personal finance is personal, but there is some finance in there, right? So you kind of need to know, and there is a mathematical equation in there as well. The way I kind of calculated this for myself was, if you're familiar with the Trinity study, and as basically pretty much to boil that down, the way I understand it is you can pretty much invest your money in stocks and bonds in pretty much any sort of combination and pull out 4%. You're going to be pretty safe over a 30-year period or so. And of course, there can be changes in the market and everything's different. But that's just a nice kind of rule of thumb that a lot of people base their decisions on. So to do that, you need to figure out how much you're going to need in retirement. And so there's the budgeting piece again, right? So you need to know how much you need to live on. And then how much to live on, then you can back calculate how much you need to save over the course of your career. And that determines how long you need to work and how much you need to store away, et cetera. So the way I've broken it down would be for every $100,000 per year that you need to spend in retirement, you would need to amass a real-time, inflation adjusted estimate of about $2.5 million. Just kind of math there. Do you guys agree with that? I mean, the rough, fuzzy numbers, but that's what I've come up with.
Yeah, I think that's I was always taught it was like 25 times what you want to live off in retirement. Unfortunately, in retirement, hopefully you shouldn't have those expenses like a mortgage, or you shouldn't have, a lot of those expenses, but you will have grandkids or great grandkids, hopefully, that I'm sure they're going to try to hit you up. So you probably need to account for more than just bare living costs. But yeah, it's at least 25 times what you want to live off of. So I think it's important to set that reverse budget for 20-30% of your gross income needs to go right off the top into your retirement and your savings and your investments. And we could talk. I think we have another podcast that's going to go over that. And I think there are some maybe basic principles, just like to think about big item purchases. I didn't want to buy a house while I was in debt. I didn't buy a house. I think that's, for some folks in an expensive real estate area, that's a good idea. It may make sense if your rent is more than your mortgage. I think it makes sense to buy a house if you're going to be at the place, if the job likes you and you like the job. But I think you have to be cognizant not to overspend, not to, your mortgage should probably be no more than 2 times your annual salary. I think that's a good general rule of thumb that's out there. And I think that, that knowing what your rates are for your mortgages, for your student loans, for your investments, and what that is going to do over time. And I think, one of the concepts that is important is probably that rule of 72. So I don't know if I'm kind of, all over the place here a little bit, but I think, in terms of like big item purchases, finish off your student loans, make sure you don't have debt, make sure you don't buy a house that's too big, make sure you don't buy a house too prematurely, because you got to make sure that the job likes you and you like the job. And then, one thing I've heard Jim Dahl say is, one job, right? One wife, that's how you kind of like get to wealth. If you're going to move around, you're not going to make that much money. You're going to lose it on moving. If, one house, one spouse. And I think one other thing, I forget what the quote is, but I apologize. But I think, just
one house, one spouse, one job.
One job, exactly. So having that stability, I think, is really, really critical. And that takes a little bit of a mindset.
Yeah, and to clarify, I think you mentioned the rule of 72. The way I understand that, divide 72 by the rate of return to see how fast your money will double. So if you're making money at 7.2%, your money will double at 10 years. And at 10%, your money will double in 7.2 years. And ironically, the same if you're borrowing something, right? So there's the same rates apply on the negative bonds, so to speak.
Right.
Let's see. I think the concepts you brought up, Sammy, are great. I think, again, especially it can be intimidating for many physicians in particular. If you've not had any training, well, gosh, I'm not a finance person. I wouldn't want a financial planner to be doing surgery on a kidney stone, right? So why would I dabble with investments and stuff? They don't feel confident even sort of looking into it. But I think these are things that these concepts I try to teach, just because they're just, again, it's all personal. A lot changes depending on where you live or what your situation is. If you have student loans, if you have an inheritance, blah, blah, blah. But kind of basic idea, how much you can kind of afford. Because guess what? The bank told me I could pretty much buy whatever house I wanted to, right? What am I approved for? How much do you want to buy? I mean, there was no question of anything like that. People will give you money and give you debt pretty readily. So I think just having basic guidelines like this gives you a little bit of confidence to proceed.
Yeah. I remembered that quote, everything you own owns a piece of you. So it's better for it to own, like the work that you did, not that the work that you're yet to do. And so I think that's part of it, not buying too much house, not buying too much car, not spending frivolously. So
I think, again, most of these bullet points we've hit on could warrant a whole podcast. I think we should probably wrap this podcast up. But I would like us to, in closing out, I'd like each of us to sort of to give a few helpful hints about, and we've touched on it throughout the podcast, but what resources have made the biggest impact on you, and kind of point other urologists maybe in the right direction as far as online content or books, etc.
So I'll start off with that. I think all of us already touched on The White Coat Investor. I think it's in its second edition now. It's a fantastic book. It's a pretty brief overview of all of this stuff. I think you can read it cover to cover in 3 hours, maybe. It's not too long. It's not too complicated. But I can speak for myself, as I already mentioned, and I think everyone here, that really was kind of like the seminal book that changed my life and really got me going down this pathway. So I think you can't go wrong with that or any of his other books, his financial boot camp books. as well as obviously his online content of the White Coat Investor. And there's multiple physician websites out there, physician-focused personal finance websites, which again, any personal finance stuff is good, but there are other physician-oriented ones, Physician on Fire, the Physician Philosopher, a bunch of different ones that I know I read regularly. And so I try to read all those blog posts, multiple blog posts a week. And I tell my residents to read at least one, besides for doing that, read at least one finance book per year. So I know, like I said, the White Coat Investor I love. I think anything by Bill Bernstein. So if the listeners don't know who that is, he's arguably probably one of the biggest and most influential financial minds of our generation. And he's also a doctor. So he was a neurologist in rural Oregon before he became like one of the biggest gurus on personal finance, I think, in the world. So anything by him, I love. And then the other book I'd recommend, it's a behavioral finance book called How to Think About Money by Jonathan Clements, which is a really good book. But I think the key is it doesn't really matter what you're reading, but as long as you're continuing getting your CMEs, if you will, in personal finance and continue to stay up to date to read books, because I think it keeps you motivated to stay on track. And it also will teach you a lot of things that you can use in your day-to-day life.
Yeah. Those are great books, Nick, and great suggestions. Thank you. I agree with all those books. I think a really quick reference that will set you on the right path right away is If You Can by Bill Bernstein. That's like a 16-page free PDF that really just puts this all into perspective very quickly. And then I think The Millionaire Next Door is an important book for behavioral finance, just going over the concept of underaccumulators of wealth and overaccumulators of wealth, and why physicians are notoriously underaccumulators of wealth, and why my in-laws, unfortunately, they had a lot, but they're not doing so great right now, and there's a whole behavioral component to this, and it's real. So I think it's important to read those two books for sure.
I love all those choices, and I would reiterate all those. The other ones that I had on my list that have not been mentioned: The Psychology of Money by Morgan Housel, relatively new book out in the last year or two. Simple Path to Wealth, J.L. Collins, very similar to like The Millionaire Store, and Mike Piper. Mike Piper writes, he's got a blog and a podcast, and writes a lot of like simple 100-page large font books, but very simple. And my favorite one by him is the Investing Made Simple. And we can talk about that in the next podcast. But just very simple about passive index funds and how impressive they are. But anyway, yeah, great stuff, guys. Well. So again, thank you everyone for joining us tonight, and thank you for listening to the AUA Leadership and Business Podcast. We'll see you next time, okay?
Thank you very much.
Thank you for listening. If you enjoyed this episode, make AUA Leadership and Business your go-to podcast. Subscribe today by searching AUA Leadership and Business on your favorite podcast app, and enhance your leadership and business education needs.